Hello, and welcome back to our series on the US and French tax systems. In this episode, we're looking at corporate taxes, how businesses are taxed in each country, and what international companies need to keep in mind when operating across borders. From tax rates to business structures, the differences can shape everything from compliance to profitability. Let's jump into it. In France, companies pay a national corporate income tax called the impôt sur les sociétés. As of 2024, the standard corporate tax rate is 25%. Small businesses with lower profits may qualify for a reduced rate. In addition to corporate tax, French companies are responsible for collecting and remitting value-added tax on most goods and services. VAT is included in the price customers see, and businesses pass the collected tax on to the government. Now let's look at the US. As we discussed in previous videos, the US has a layered system. At the federal level, corporations pay a flat 21% corporate income tax. But most states also impose their own state-level corporate taxes, and those rates can vary significantly. What makes it more complex is that each state can only tax you if your business has a nexus there, meaning a real connection, like having employees, an office, or customers in the state. And once that connection exists, the state uses a method called apportionment to figure out what share of your total income it can tax, based on how much of your activity happens in that state. So, depending on where your business is based, you might be taxed at the federal level only, in states with no corporate tax, or both the federal and state levels, in states with corporate tax. Another key difference? The US does not use VAT. Instead, it uses sales tax, which is added at checkout and set by individual states or local jurisdictions. While France has one national VAT system, the US has a patchwork of rules, with different rates, rules, and exemptions, depending on where your customer is located. This creates complexity for businesses selling across multiple states. Business structure also plays a major role in US taxation. US companies can choose different entity types, including C Corporation, which pays corporate tax directly, S Corporation, and LLC, limited liability company, which are often taxed as pass-through entities, meaning profits are taxed on the owner's personal tax return, or sole proprietorships, which follow a simpler pass-through model. Choosing the right structure is both a legal and tax planning decision, and it can affect how, where, and how much you pay in taxes. In France, business types are more standardized. The most common include SARL, Société à responsabilité limitée, Private Limited Company, SAS, Société par action simplifiée, Simplified Joint Stock Company, SA, Société anonyme, Public Company. Regardless of the structure, these companies all fall under the same national corporate tax system, with less variation in treatment compared to the US. In the next episode, we'll shift gears and explore audits and penalties, what happens when something goes wrong, and how to stay on the safe side in both systems.